Welcome to today's Explainer. We are going to break down the exact blueprint for taking a single $1,000 seed and growing it into a towering financial asset in 2026. If you've been sitting there wondering exactly how to kickstart your financial journey with a completely manageable sum of money, you are in the perfect place. So, let's jump right in.
Now you might be asking yourself, can $1,000 actually change my life? Because honestly, at first glance, it might not seem like some massive life-altering pile of cash. But making the conscious decision to invest this amount, that's probably the single biggest financial milestone you can hit. Why? Because it completely shifts your mindset. It literally transforms you from a passive consumer into an active participant in the global economy. And look, by 2026, the financial landscape has changed drastically. We're dealing with high interest rates, insane technological disruption, and we suddenly have unprecedented access to really sophisticated investment vehicles. Your $1,000 is a really powerful seed, and we're going to show you exactly how to plant it.
Here's our step-by-step roadmap for today. First, the investing mindset. Second, securing your financial perimeter. Third, building your 2026 portfolio. Fourth, the magic of compounding. And finally, avoiding common investment pitfalls.
Step 1. The investing mindset, the philosophical foundation of investing. Before you even think about opening a trading app on your phone, you have to mentally gear up for an ultra-marathon, not a sprint. The market is inherently volatile. In 2026, we are constantly facing macroeconomic shifts, geopolitical tensions, and inevitable market corrections. To survive all that noise, you absolutely need these three pillars. First up, patience. You just have to sit back and give compounding the time it needs to actually work. Second, discipline. You gotta stick to your plan even when the news is screaming about sheer panic or irrational euphoria. And third, knowledge. This is the golden rule. Never ever put your money into something you don't actually understand.
Step 2. Securing your financial perimeter. Basically clearing the swamp before building.
Think about building a skyscraper for a second. You would never try to build a massive sturdy structure on top of a swamp, right? Well, before putting your $1,000 into the market, you have to secure your financial perimeter. And that means tackling your liabilities first. 20% or higher. That number represents the mathematically devastating interest rates you'll typically find on credit card balances right now. If you're carrying high-interest debt, your money is literally leaking out of your foundation faster than you can pour it in.
So what's the fix? Clearing that debt. It is genuinely the highest guaranteed return you are ever going to find. Look at the math. No stock or bond out there is going to consistently beat the massive interest the bank is charging you. Taking your cash and wiping out a 20% debt is literally a guaranteed risk-free 20+% return. It completely clears the swamp.
Okay, so the debt is gone. Now you have two immediate priorities, a high-yield savings account or a 401k match. Because life happens, you need liquid cash. If you tie up your entire $1,000 in stocks and then have to sell them at a loss just to fix a broken alternator in your car, you've completely defeated the purpose. You need an emergency fund in a high-yield savings account, which right now in 2026 offers great rates to help shield your cash from inflation. Now, on the flip side, if your boss offers a 401k match, that is non-negotiable. If you put in $1,000 and your company matches it, you just doubled your money. Bam! Capture that immediate 100% ROI before you do anything else.
Step 3. Building your 2026 portfolio. Framing the structure of wealth.
All right, here is the exact allocation for your $1,000 seed. We aren't just guessing here, we're breaking it down into 4 strategic slices. 50% for your core strategy, 30% for tech growth, 10% for income, and a really crucial 10% for a learning fund. Let's dive into the logic behind this setup.
Let's start with the biggest chunk. Half your money, $500, is your core strategy. Look, the greatest investors in history, including Warren Buffett, constantly recommend low-cost, broad market index funds. When you buy an S&P 500 ETF, you're basically buying a tiny, perfectly diversified slice of the 500 largest companies in the US. You aren't trying to pick one magical winning company. Instead, you're placing a bet on the long-term innovation and expansion of the whole American economy over the next 10, 20, or 30 years.
Now for the rest of it. The next $300 captures the momentum of the mid-2020s tech boom. Using thematic ETFs, think artificial intelligence, cloud infrastructure, sustainable energy. Then another $100 goes into dividend-focused ETFs to build a steady floor of income. But honestly, pay close attention to this last part, the learning fund. Putting $100 toward books, financial courses, and research platforms, investing 10% into your own brain is probably the most important $100 you'll ever spend. Your mind is your greatest asset in 2026. Learning exactly how interest rates affect bond prices or how earnings reports move the market is exactly what's going to prepare you to handle your next $10,000.
Step 4. The magic of compounding. Letting time add the upper floors.
So, the portfolio is built. Now we have to protect it from our absolute worst enemy, our own emotions. The biggest mistake rookies make is trying to time the market. They wait around for prices to drop, or they absolutely freeze when the market hits an all-time high. The cheat code here is dollar cost averaging, or DCA. It simply means investing a set amount of money on a strict schedule, completely ignoring whether the market is up or down that day.
Let's compare how this actually looks. You could do a lump sum, just drop the whole $1,000 in today. Or you use dollar cost averaging, where you commit to investing just $100 every single month for 10 months. DCA is a beautiful mechanical strategy. It totally removes the stress of trying to predict the future. Because you're on the schedule, you automatically buy more shares when prices are cheap and fewer when they're expensive. It averages out your cost over time, and trust me, it completely kills your day-to-day anxiety.
And you absolutely have to put this money to work. The 2026 news cycle is practically designed to freak you out, constantly yelling about recessions or currency crashes. But here's a hard truth. Keeping your cash stuffed in a basic checking account earning 0% interest, that is a mathematically guaranteed way to lose wealth. Inflation is just sitting there, silently eating your purchasing power. Investing is how you fight back, outpace inflation, and actually build real wealth.
Okay, prepare yourself because the math on compounding is just breathtaking. Say you invest that $1,000 at a super conservative historical average return of 8% a year, and you never add another single penny. By year 10, it grows to $2,158. Year 20, $4,660. And by year 30, it has exploded to $10,062. That is exponential growth. Now just imagine what happens if you combine that with dollar cost averaging and add just $100 a month. The reason most people don't build wealth isn't because they aren't smart enough, it's because they simply run out of time. They start too late.
Step 5. Avoiding common investment pitfalls. Structural traps to watch out for.
As you start building this, you have to actively dodge the behavioral traps that can instantly wreck your portfolio. Let's hit the 3 big ones quickly. First, the FOMO trap. Do not buy a stock just because it's trending on your timeline. If you don't understand how the company makes money, stay away. Second, the over-trading trap. Every time you hit buy or sell, you're risking trading fees and nasty tax surprises. Over-trading is the fastest way to turn your $1,000 into $500. And third, the get-rich-quick scheme. If anybody promises you a massive guaranteed return with zero risk, run. Just run. Those are the absolute textbook signs of a scam. As we wrap up this explainer today, I really want you to remember something. The wealthiest people aren't always the ones making the massive salaries. They are simply the people who have mastered the art of keeping and growing their capital. Investing your $1,000 in 2026 is about so much more than watching green and red numbers on a screen. It's about developing an abundance mindset. It's realizing that you actually have the power to take definitive, absolute control of your financial future. You have the tools, you have the access, and now you have the blueprint. So all that's left is for you to actually take action. I'm going to leave you with this final, provocative thought to chew on. The greatest asset you have in 2026 is time. Will you use it? By taking that first $1,000 today, you are buying yourself the most valuable resource in the world. Respect your capital, let it compound, and let it be the bedrock for a lifetime of real financial freedom. Your journey starts right now.